Welcome back, family. Thanks for watching. Make sure that you like, subscribe, and share. Yeah, thanks for tapping in with me. Appreciate that. Today I don't want to take much of your time, but I did want to just speak on kind of the recent events and what's been going on with Robinhood, and then also just the skyrocketing of like GameStop and AMC and things like that. And really, the reason I want to touch on those things is really to differentiate something. And I really want to speak on it because, like my last video and in videos prior, I spoke about investing. But with that and with the stock market, one thing to consider and understand is that there's a big difference between investing and trading. Not every trader is an investor, but most investors do some trading. And so like that thing with GameStop was trading. Would it be a great representation of what trading looks like, and just real quick volatility, get in, get out type thing. And I would not recommend that for people that are not really informed when it comes to stock securities, valuing companies, and things like that. Because at one point, GameStop, with the stock price, the ticker price was over $300 a share, when the fundamental value of the underlying asset, which is GameStop, the business, is not. I think I dare to say is worth less than $20 a share. And so I say that to say that it's almost like a Ponzi scheme, in the sense that that price is going to continue to go up as long as suckers, so not to call people suckers, but as long as somebody's willing to pay that high price. There's no value there, and at some point it is going to crash. Like, it's not a matter of if, it's a matter of when. And if you get stuck holding the bag because you're uninformed, or you just got wind of it and now you want to jump in because it's hot and people are talking about it, yeah, that can be dangerous, and that could leave you in a position where you lose a lot of money. So I just want to make sure that you guys kind of understand that, when you're investing, that is a long-term play. You're putting your money in the stock market, you're looking at companies, or you maybe a fund. I definitely suggest funds, index funds, or ETFs, things that give you a collective or a group of stocks that you could buy for usually a price is less than a lot of these big corporations that you would pay for that individual stock. You can get actually like a pool of stocks. Vanguard offers these type of things. Fidelity offers different types of funds and ETFs, and there's plenty others that you can look into. I definitely suggest those type of ETF index funds and things like that. Those type of tools for people that are not going to dedicate the time, one, to understand and value companies, and then also to just understand kind of the dynamics of the stock market. Those funds, those ETFs, they can be a really good alternative to kind of just set your money and forget it. Like, it will ebb and flow with the market, grow with the market, and then also you're instantly diversified because you're buying a collective of different companies that have already been vetted by professionals, by stock analysts, market analysts, and things like that, people who do this for a living. And that way you take a lot of that guesswork out of it and a lot of that gambling out of it. Yeah, and also with that, I just want to make sure that I just touch on just that difference. And another thing with that is that if you're hearing about it in the news, you're probably already too late to act on it. The move has already been made. The big opportunity has already passed. You're hearing about it because there was something big that has happened. And so it can be dangerous to go off of headlines and things like that, things that you're hearing, especially when you can tell that it has the world's attention at this point. It's kind of already too late, like the secret's out the bag type thing. So just be mindful of that as well. When you start to hear these things creep up in the news, you might want to steer clear and kind of watch from afar, see what you can learn about the situation, watch how it plays out, but not necessarily get involved yourself, or expose yourself financially by buying into some company where the value's not there, or whatever the case may be. So yeah, like I was saying, it's really great to invest in these funds because they can give you exposure to so many different stocks. But if you are one that is adventurous and maybe looking for a little bit more growth, or what they actually are called as growth stocks, a lot of times it could be some of these companies you might be familiar with, none of which I am going to name, just because this is not investment advice. This is just kind of how I approach things and things that I consider. So I'm not going to tell you any particular individual stock to invest in. But yeah, if you're one of these people that is kind of adventurous, you want to get involved with some of those. You a few ways you can go about that if you're not really one that is who is really familiar with just digesting financial information and looking at companies like that. Some of these same funds, you can go and look at some of the companies that are contained in their funds. So, for instance, there's a Vanguard fund that's ticker is VOO. I can't tell you off the top of my head any companies are in it, but just for example, you can look up that ticker symbol and then look to see what companies make up this fund, and then kind of pick, companies that are within that you might want to see or get exposure to individually that could potentially grow faster than the fund itself. And what I mean by that is, let's say you have within a fund, it has companies that are within the technology sector, which really tends to have exponential growth in a lot of cases. In some cases, I'll say, because of the fast and rapid development of it. You see that with a lot of different companies that have just had stock prices that just explode and grow and things like that. So let's say you go in there and you see it has companies like that, but also maybe it has some maybe your staple retail stocks in there as well, which are going to be more better for maybe the long-term investment. Maybe they pay you a dividend, or maybe it's going to just give you stability and slow growth, right? And so the reflection of the performance of that overall fund is going to be a cumulative performance of those and all other stocks within that. What I mean by that is that cumulative growth can be slower than maybe the growth of just that technology company that we're using in this example, right? So I say that to say that you can go look at these funds and see the companies that are in them. And maybe, now that you know that it's at least been vetted by this fund or the people managing this fund, that it might be, or that it's likely to be some actual sound and fundamental business practices in place with these companies, you can maybe then explore and buy some of those individually. Maybe buy a few shares of a company or two within that fund, in addition to holding that fund itself. And that could be a good way to get your feet wet and get more exposed. But obviously, the best thing to do is to educate yourself and get more comfortable with maybe consuming financial information and things like that, because the best person to make a decision like that is, if you're going to put your money in, is you. So, but these are just some kind of quick hacks, if you will, or ways to sidestep this, especially in the beginning, because one thing that I don't want to happen is that you become paralyzed by the fear of getting in because you feel you don't know. Like, these funds can be so helpful and so grateful to just get in. It takes out or removes the weight of having to pick the right company or pick the right one, or whatever the case may be. You could just buy this fund and it's going to pick the companies for you. The way that they generate customers is by their performance. So they're inclined, or they're motivated or incentivized to be able to pick companies that are going to grow and produce a return for you, or produce a return for all their customers. I say that to say that they are incentivized to provide good, strong companies within their portfolio, or whatever that that is within that fund. And so, it takes that guesswork out of it. It saves you that step, that time, because that can be time consuming for sure, especially if you're new to it and you haven't done some of the prerequisites, if you will, to familiarize yourself with the lingo, because that in itself could be challenging, and understanding what certain numbers mean and what numbers you should even be looking for to begin with. It can kind of really save you there. Another thing that I would say is that you don't have to, and I kind of mentioned this in the video before, that you don't have to have a whole boatload, truckload of money to begin. Like, a lot of these platforms, and again, I'll leave my link in the bio if you're not already set up on them, like CASHAPP, Robinhood. Both of those for sure allow you to make investments with as little as $1. And a lot of times, I know for myself, I send and receive cash on Cash App, quite frequently. And so sometimes I just leave a few dollars in there, and that's what I'm going to use it to invest with for this week. Just do $1 a day, $7 a week. Put you $1 here, put you $1 there. With Cash App, one thing to be mindful of is that some funds may not be available on there. You might have to use a Robinhood or something like that. But I'll leave a link to both, as well as a link to my WEBULL. You can invest with WEBULL as well. However, WEBULL does not currently offer fractional shares, meaning that you can't buy a share for $1. You do have to pay whatever it is the price is trading for currently. But if you're in a position to do that, because stocks vary in price, so don't let that shy you away from it. And when you sign up with WEBULL and you deposit $100, you get a free stock. I get a free stock. That's free money, free wealth. You can just sit back, let that grow, or after a few days, it's what they call settle, where it becomes available, where you can actually trade it or whatever, and then you can cash it out or buy a stock that you actually want. I'll leave the link to those down there for you guys to sign up if you're not already on those, and if you're already on one, I always suggest getting on another, or really getting on all, because one thing that we did see with this whole GameStop debacle and Robinhood is that, these platforms have the power and control to halt trading when they want to freeze trading, or even force you out of positions. For those of you that have followed some of the details surrounding the story, they halted being able to buy the GameStop share at a certain time or during a certain period for a day or more, and then even after that continue to limit the sell and buy of it and other securities. I think even still currently, they're rationing the amount of activity surrounding certain tickers. And so I say that to say that if you are on different platforms, things like that won't necessarily prohibit you from trading. If for instance, if they're rationing a particular stock that you want to get in on, or whatever the case may be, you won't be kept out or have to be faced with something like that because you have money in a different account on a different platform, or an account or a relationship on a different platform where you can trade as well. Even in addition to these apps like WEBULL and Stash and all these other ones, you still have your more traditional brokerages as well. I also have accounts with them as well. So for those of you looking to set up, retirement accounts, whether it be in addition to your employer retirement account, or maybe you're a self-employed and you want a solo 401k, you might try looking into accounts that are offered by bigger brokerage companies like a Vanguard, like a Fidelity, because those accounts, if you have the right type of account, you can trade stocks through those type of accounts as well, stocks and securities, and also do it in a way that is potentially more tax friendly to you. Check with your tax professional or attorney though to make sure that apply or would apply to you or could apply to you. Yeah, I just kind of wanted to share that with you, and just to recap, I just wanted to say that, one, there's a big difference between investing and trading. What I promote is investing, and that is, putting your money in sound, solid places where it can grow and mature over time and bring you a solid, good return. Not just going or buying into FOMO, and what I mean by that is fear of missing out. And in the sense of, people are talking about something, let me get in. No, that's trading. And trading, although it has its place, for one, it's not for everybody. It's not for the uninformed, ill-informed, or uninformed. And so, yeah, just be careful of that, especially if you're a newbie, especially if you're just starting out. You're trying to really build like a nest egg or something for your family or for your children, or for yourself. You want to be investing, not necessarily trading, and especially not with your nest egg. If you are wanting to participate in trading, I would advise that to be a different portion of your stock portfolio strategy. Let it not be the bulk of your money, or something that you can't go without, or lose, and not be okay with losing. So yeah, I would just tell you to consider those things, think about those things. And then also the other thing is that choosing to invest in ETFs or funds or in other different indexes can allow you to sidestep potentially some of the work that would be needed to pick an individual stock, whether that means considering the financials of a company, or considering different aspects of a company to see if it's healthy and see if it's sound. You can turn to index funds and ETFs as a way to kind of save yourself from doing your homework. One thing I will say to consider with the different funds is expense ratios. And that essentially is how much the fund charges you to run the fund. That's their service fee, if you will. So that would be one thing to consider. Usually it's not a whole lot of money, especially, if you just investing a few $1,000s. It could add up over the course of maybe 10 years to maybe a few $100s, but it's not a whole lot of money. But as your wealth grows, it might be something you want to be more mindful about in the future, and may cause you to shop around and consider different things. But also with that, when considering the price of the fund, you want to also consider the returns of the fund. So, it could be a situation where maybe a fund costs a little more, but it generates a better return than other funds. So those are things that you may maybe consider later. The biggest thing is to get started, is to just get out there, and get your money invested. Because as I mentioned in a previous video, putting money in savings accounts, for one, it's not even going to save you from inflation, let alone grow your money. Your money is actually going to depreciate at an average rate of about 2%. So that, again, using the same example or analogy from the previous video, if you have $100 this year, and a year from now, the spending power of that $100 will be equivalent to $98. And the reason that happens is because, prices go up. So the buying power is lower and lower. And so if your money's not increasing as the price of goods and services goes up, you're losing buying power. So just hoarding money, like you don't keep money in a mattress or anything like that, or on your couch, unless it's just your emergency, get out of town money, so to speak, or something like that. But you want to put your money in assets, things that grow, things that appreciate. You want your money to work for you, because for the obvious reason, you can't work forever, but you still want to be able to enjoy life and generate money to support yourself, support the people that you love, and do the things that you desire to do. So yeah, it's just very important to do that things, and the time is to start is now. Like I promise you, I've already started. I'm still late. I wish I would have started, when I was a kid. Not to say that my parents didn't do certain things for me, but I wish that they started me a brokerage account. And if they did, I don't know about it to this day yet anyway, but wish they started me a brokerage account, before I was born, when they found out my mom was pregnant, and just start, putting $1 in it just every day, and what it would be now. Like, I would have to do the math and things like that, but I wouldn't doubt it'd be over $1 million. I'm 33, I'll be 34 in a few months, and just $1 a day, for that amount of time, it might even be a couple $1 million, honestly. And so I just ask you to think about the kind of impact that can have on those that are coming after you. Maybe you didn't have it when you started out. Maybe nobody thought that much during those times. Maybe they weren't educated enough, they knew nothing about it, so they couldn't do it. But now like you've heard or you've seen this video, and so you now know. And I would just urge you, so many other communities where they do have resources, because they have stock market participation. And so now that I would urge you to get started. Like I said, so many platforms will allow you to start with something as little as $1. And especially with these platforms like CASHAPP, where you already have an account, all you got to do is click that little tab at the bottom, that whatever it is, and get involved, get started. And one thing I would also caution you with is, yes, the stock market goes up and it goes down. But I would caution you to think about it like this: when it goes down, things are on sale. Look at it that way. And if you had a stock that was $50 yesterday, and over the next day it goes down to $48, well, nothing probably has fundamentally changed with that. So the value hasn't really changed, the value of the company or the value of the portfolio, if you're talking about an index or a fund, right? And so this is really just an opportunity for you to buy more of the same at a discounted price. And I would urge you to look at, red days or down days in the stock market is that. So if you got some extra money, it's a red day, buy back in, because the thing is, when you buy into a fund, when you buy into a company, it's because you believe in it, or you believe that, the people that are running this company or running this fund are doing it to, one, be profitable and generate a return, therefore that your money will increase, the asset will continue to increase in value, and you'll have a larger return. But yeah, you do it so that your money can increase in value. Don't look at it in the sense that you've lost money. You haven't lost anything. For instance, if you're the price of your house, if you got an appraisal, for instance, every day on your house, the price of your house, the value of your house would change from day to day, because the market does fluctuate. And I won't say day to day, because real estate doesn't quite move that swiftly. If you got your house appraised on a monthly to year basis, you'll know that the price of the house does go up sometimes, especially when the economy is doing well, or sometimes it goes down. But I say that to say that it only matters when you're ready to sell. So if your stock goes down, it's not that big of a deal unless you're looking to sell today. And I would urge you not to sell if it's down. The whole point is to make money. If anything, you want to buy when it's down. You buy low, sell high. So you don't sell when it's down. You hold or buy more, and you wait for the value to go back up, because again, you believe in the companies that you're buying in, or the funds that you're buying in. And it's just a bad day. Headlines, as you can see, can drive prices up or they can drive prices down, but it really doesn't change the underlying value. That's really the point that I'll be driving home with GameStop, is that people drive up this price where it really has no value. There's nothing there to support it other than people saying that they're going to pay it, and say screw you to the big guys, which I don't knock them for it, but I'm just saying there's some people, some little guys that are gonna be eager to get in, and not knowing that a hammer is going to come down at some point regarding that. And as you can already see, I think even just today alone, GameStop has dropped over $100. Might be actually trading under $100, and like I mentioned earlier in this video, it was trading at 300 at one given time. So yeah, some people are really getting hurt, and I just hope it's none of you. So yeah, but yeah, thanks again, people, family. I appreciate y'all tapping in with me and lending me your ear and your eyes for a second. Hope this was helpful. And don't forget to like, subscribe, and share. Once again, in the description, I'll leave a link to Robinhood, WEBULL, Cash App. Feel free to check those out if you need an account to go ahead and start investing. And with all of those, you have the potential, if you use my link, to get free stock, and I will as well. But thank you, peace, take care, and I'll talk to you on the next one. Bye.